Hi guys, now we'll continue with the problem number 5 which we stopped in the previous video. Previous video we were doing this problem number 5, whereas due to some network issues it got disconnected. Okay, now we'll move on to problem number 5. With the help of the following information, complete the balance sheet of MNOP Limited. Equity share capital rupees 1 lakh. See what they are asking. They are asking us to complete the balance sheet, that is prepare a balance sheet using the given ratios. That is, they have directly given that equity share capital is rupees 1 lakh. So we have found one point of the liability, that is equity share capital. The relevant ratios of the company are as follows. What are the different ratios they have given? Current debt to total debt, that is 40%. Current debt as a percentage of total debt is 40%. Total debt to owner's equity is 60%. That is, total debt compared to owner's equity. Suppose our owner's equity is 1 lakh. So 1 lakh into 60% is total debt. So 60,000 is the total debt. That way we should find the values of balance sheet, different values of balance sheet. Next is fixed asset to owner's equity. That is also 60%. Total asset turnover is 2 times. What is the formula for total asset turnover? Total asset turnover formula is net sales divided by average total, that is average assets, like opening assets plus closing assets divided by 2. If only total assets is there, net sales divided by total assets. Then inventory turnover. What is the formula for inventory turnover ratio? Cost of goods sold or sales, any one value divided by average stock, that is opening stock plus closing stock divided by 2. That is inventory turnover ratio. So these are the different formulas they have given. With this we have to find what is the, with this we have to formulate the balance sheet. So come to the solution, that is problem number 5. Put the heading problem number 5. Problem number 5, balance sheet of MNOP Limited. Balance sheet of MNOP Limited. Below that, divide the page into 2 parts. Left hand side liabilities amount. Left hand side liabilities and amount. Right hand side assets amount. Right hand side assets amount. Liabilities amount and right hand side assets amount. Below liabilities, first record equity share capital. They have given directly it is 1 lakh. So below that liabilities record equity share capital. Equity share capital. Amount column record 1 lakh. Amount column record 1 lakh. Only it has been given. All the other details has not been given. So we have to use these different ratios to find the other values of balance sheet. So leave 10 lines gap. Leave 8 lines gap. Below that equity share capital, give 8 lines gap. Put working notes. Put working notes. Using these different ratios, we should find values of balance sheet. That is, what is debt, what is current debt, what is long-term debt. All these things we should find using this ratio. Now working notes. Below that working notes, point number 1. Point number 1. See the second ratio, that is total debt to the owner's equity is 60%. Here owner's equity is 1 lakh. So 1 lakh into 60% is the total debt. So what is the formula for total debt to owner's equity? Total debt divided by equity share capital into 100 is equal to 60%. So equity share capital into 60% is equal to total debt. So point number 1, below working notes, point number 1, total debt is equal to equity share capital, that is 1 lakh into 60%. 1 lakh into 60% is equal to 60,000. Is equal to 60,000. How did we find this? Using the second ratio. That is total debt to owner's equity is 60%. Here we know owner's equity is 1 lakh. When owner's equity from denominator goes to the right hand side, it becomes numerator. 60% into 1 lakh is 60,000. So total debt is equal to 60,000. So below that, point number 2. Point number 2. See, here they have given current debt to total debt is 40%. That is, out of total debt, 40% is current debt. So point number 2. Current debt is equal to what is total debt? We have found 60,000. So 60,000 into 40%. 60,000 into 40%. Why it is 40%? Here they have given current debt to total debt is 40%. Out of total debt, 40% is current debt. So 60,000 into 40% is equal to 24,000. 24,000. Next is point number 3. See, out of total debt 60,000, current debt is 24,000. Then remaining is long-term debt. Simple. So long-term debt is equal to point number 3. Long-term debt is equal to total debt minus current debt. Total debt minus current debt is equal to 60,000 minus 24,000. 60,000 minus 24,000 is equal to 36,000. Is equal to 36,000. With this, we have found two things, that is current debt and long-term debt. So coming to the liability side, below the equity share capital, record long-term debt. Long-term debt within bracket note number 3. Long-term debt within bracket note 3. Amount column record 36,000. Amount column record 36,000. Below that, record current debt. Current debt within bracket note number 2. Within bracket note number 2. Amount column 24,000. Amount column 24,000. Now, see, any other details regarding liabilities have they given? No. They have given current debt, that is part of total debt. So, current debt and long-term debt are two liability items and equity share capital. Other than that, no other liabilities are there in the question. So, total the liability side. 1 lakh plus 36,000 plus 24,000 is 1,60,000. Now, total amount column put 1,60,000. So, if liability side is 1,60,000, asset side also total it 1,60,000. 1,60,000. So, total assets is equal to 1,60,000. What we have found now is when total liabilities is 1,60,000, total assets is also 1,60,000. But we don't know what is assets still. So, below that third working note, put point number 4. Point number 4. Put the heading calculation of inventory. Calculation of inventory. Okay, now in this point number note, working note number 4, we are going to find what is inventory. So before that, what are the two ratios which we didn't use till? Total assets turnover and inventory turnover ratio. So assets turnover ratio, they are given 2 times. What is the formula for assets turnover ratio? Sales divided by total assets. Here we know that total assets is 1,60,000. So total assets turnover ratio is equal to, put assets turnover ratio is equal to sales divided by total assets. Sales divided by total assets. How did we find the total assets? We just totaled the liability side. Total of the liabilities is the total of the assets. So sales divided by total assets. So here we know asset turnover ratio is 2 times. So sales is equal to 2 into 1,60,000. 2 into 1,60,000 is equal to 3,20,000. Is equal to 3,20,000. So now with this we can find, we have now found that what is sales. By using sales and inventory turnover ratio, we can find what is the closing inventory. So below that, put inventory turnover ratio is equal to, what is the formula for inventory turnover ratio? Cost of goods sold divided by inventory, or sales divided by inventory. That is average inventory. So here below that, inventory turnover ratio is equal to sales divided by inventory. Sales divided by inventory. So when inventory goes to the left hand side and inventory turnover ratio comes to the denominator, inventory is equal to 3,20,000 divided by 8. 3,20,000 divided by 8 is equal to 40,000. So inventory is 40,000. In this particular working note number 4, we have found that inventory is 40,000. Inventory is 40,000. So one more third ratio we didn't use till. Other 4 ratios we used. That is fixed asset to owner's equity is 60%. Below that point number 5. Fixed asset to owner's equity. That is fixed asset is 60% of owner's equity. Here how much is the owner's equity? 1 lakh. Into 60% is the fixed assets. So point number 5, fixed assets is equal to equity into 60%, because fixed assets to owner's equity is 60%. That is fixed asset is 60% of owner's equity. So owner's equity is 1 lakh into 60% is fixed assets. So fixed assets is equal to equity into 60% is equal to 1 lakh into 60%. Is equal to 1 lakh into 60%. that is equal to 60,000. So we have found fixed assets as 60,000 and inventory is 40,000. Now come to the balance sheet. Below the assets column, record fixed asset amount column 60,000. Fixed asset amount column record 60,000. Below that fixed asset inventory, below the fixed assets inventory amount column record 40,000. Amount column record 40,000. So we have found fixed assets and inventory. We don't know the other current assets yet. So other current assets are also called as quick assets because inventory has been removed. See, normally all are current assets except fixed assets. But if fixed assets and inventory are shown separately, then remaining are quick assets because quick assets is nothing but current assets minus inventory and prepaid expenses. So we should call it as quick assets, which is a balancing figure. So quick assets within bracket balancing figure. Quick assets within bracket balancing figure. How much is the balancing figure? 1 lakh 60 minus 1 lakh is 60,000 in the amount column. 60,000 in the amount column. We'll show it in the separately in the working notes also. No. Point number 6. Below that point number 5. Point number 6. Quick assets is equal to total assets minus fixed assets minus inventory. Total assets minus fixed assets minus inventory, which is equal to 1,60,000 minus 60,000 minus 40,000. 1,60,000 minus 60,000 minus 40,000. So quick assets is equal to 60,000. So answer is 60,000. 1,60,000 minus 60 minus 40 is equal to 60,000, which is quick assets. And below that, one more additional point they have written, but which is not required, but still you write it down. Working note number 7. That is note number 7 is current assets is equal to total assets minus fixed assets. Current assets is equal to total assets minus fixed assets. Here total assets is equal to 1,60,000. Fixed assets is equal to 60,000. So 1,60,000 minus 60,000 is equal to 1 lakh. Is equal to 1 lakh. Next is, with this we have completed problem number 5. Next we will move on to problem number 6. Problem number 6. Using the following data, prepare the balance sheet. That is what and all the different data they have given. Gross profit 54,000. Shareholders fund 6 lakh. That is equity shareholders fund is 6 lakh. Gross profit margin 20%. So now they have given gross profit as 54,000 and gross profit margin is 20%. Divided by 20% if we do 2,70,000, which is the sales. So 54,000 divided by 20%. That is gross sales is equal to gross profit divided by gross profit percentage. We'll get total sales. So 2,70,000. So if total sales is 2,70,000 and the profit is 54,000. So cost of goods sold is 2,16,000. With this we have found sales, what is gross profit and what is the cost of goods sold with the gross profit and gross profit margin itself. So below that, credit sales to total sales. We have found 2,70,000 as total sales. Out of that 80% is credit sales. That is 2,16,000 is credit sales. And total assets turnover is 0.3 times. Total assets turnover, what is the formula? Sales divided by total assets. So here we found sales is 2,70,000. So 2,70,000 divided by assets is equal to 0.3. So if we take assets to that side, total assets to left hand side, and if we bring the 0.3 to the right hand side denominator, 2,70,000 divided by 0.3. That is 9 lakhs is the total assets. I'm simply giving a brief thing where in problems we will see one by one. And next is inventory turnover ratio. What is the formula for inventory turnover ratio? Simple. Cost of goods sold divided by average inventory. Here we know what is cost of goods sold, 2,16,000. So 2,16,000 divided by 4, that is inventory turnover ratio. So total inventory is 54,000. So closing inventory is 54,000. And next is average collection period. That is 360 days here 20. So collection period. What is the formula for average collection period? 360 divided by debtors turnover ratio. So here days we know, and we know that 360 days is 20 days, and 360 divided by 20 we'll get what is debtors turnover ratio. That is 18. Debtors turnover ratio is 18. With this debtors turnover ratio we can calculate what is debtors. Debtors is nothing but credit sales divided by average receivables. So average receivables is, sorry, debtors turnover ratio is net sales credit sales divided by average receivables. So here we know debtors turnover ratio as 18, and we know that credit sales is 2,16,000. So if we divide 2,16,000 divided by 18, we'll get what is debtors, that is 12,000. So next is current ratio. They have given current ratio, which means current assets minus current liabilities. And next is they are given long-term debt to equity. Here we know equity is 6 lakh and long-term debt is 40% of that 6 lakh, that is 2,40,000. So we have to find all this and prepare a balance sheet. Using all these ratios, we have to prepare a balance sheet. We'll go one by one. Very easy sum. Okay, now come to the answers. Come to the notes. Problem number 6. Problem number 6. Balance sheet of dot dot as on dot dot, because they haven't mentioned anything. Balance sheet of dot dot as on dot dot. Below that, divide the page into two parts. Liabilities amount. Left hand side liabilities amount. Right hand side assets and amount. Left hand side liabilities amount. Right hand side assets amount. So below that liabilities, first write what is equity. They have given shareholders funds 6 lakh. They have given directly shareholders fund is 6 lakh. So equity amount column put 6 lakh. Below the liabilities record equity amount column 6 lakh. And they have in the end they have given long term debt to equity is 40%. So long term debt, below that open a bracket 6 lakh into 40%. Below that open a bracket 6 lakh into 40%. Now close the bracket. Amount column write 2,40,000. Amount column write 2,40,000. So these are the two items which they have given on face, whereas other items they have given ratios. So we're using the ratios, we should fill up all the items in the balance sheet. So below that, leave below the long term debt, leave 7 lines gap. These 7 lines gap. Working notes. Working notes. Below that point number 1. Below that point number 1, calculation of sales. Calculation of sales. Here they have given gross profit percentage and also they have given gross profit amount. Using this we can find net sales. So calculation of sales, below that gross profit percentage is equal to gross profit ratio or percentage. Gross profit ratio is equal to gross profit divided by sales into 100. Gross profit divided by sales into 100. Here they have given gross profit is 20% and gross profit percentage is 20% and gross profit is 54,000 divided by sales into 100. So 54,000 divided by sales is equal to 20%. If sales goes to the left hand side, it becomes numerator, and 20% when comes to the right hand side becomes the denominator. So sales is equal to 54,000 divided by 20%. So sales is equal to 2,70,000. So we have found that sales is equal to 2,70,000. And with that we know what is sales now, 2,70,000, and what is gross profit, 54,000. If we reduce sales minus gross profit, we'll get cost of goods sold. Below that point number 2. Below that point number 2, cost of goods sold is equal to sales minus profit. Sales minus profit is equal to, what is the sales? 2,70,000, which we found in the working note number 1. 2,70,000 minus 54,000 minus 54,000. So is equal to 2,16,000. 2,16,000. Below that, point number 3. Below that, point number 3. They have given credit sales to total sales is 80%. So we know total sales is 2,70,000. Out of that, 80% is credit sales. So point number 3, credit sales is equal to 2,70,000 into 80% is equal to 2,16,000. So cost of goods sold is also 2,16,000. Credit sales is also 2,16,000. But cost of goods sold is calculated by reducing the sales minus profit, whereas credit sales is calculated by 80% on total sales. And below that, they have given total assets turnover is 0.3 times. What is the formula for total assets turnover? Sales divided by total assets. So below that, point number 4. Below that, point number 4, calculation of total asset. Calculation of total asset. Below that, asset turnover ratio, ATR is equal to sales divided by total assets. ATR is equal to sales divided by total assets. If total assets goes to the left hand side and ATR will come to the right hand side, ATR becomes denominator. So total assets is equal to 2,70,000 divided by 0.3. So 2,70,000 divided by 0.3 is the total assets. So amount column, right, 9 lakh, is equal to 2,70,000 divided by 0.3 is equal to 9 lakhs. 9 lakhs. So we have found total assets. So now come to the balance sheet. In the total assets column, leave 6 lines gap and total it 9 lakh rupees. 9 lakh rupees. How did we find that? By calculating the asset turnover ratio. So 9 lakh rupees. If total assets is 9 lakh, liabilities is also 9 lakh. So liability side also close the liabilities balance and write 9 lakhs. Close the liability balance. It is also 9 lakhs. So equity and long-term debt is 8,40,000. Total liability is 9 lakh. So total liability 9 lakh minus 8,40,000. So remaining 60,000 is the balancing figure, that is current debt. So below that long-term debt, put current debt, that is current liabilities, current debt, put it as current debt, within bracket balancing figure. Within bracket balancing figure, amount column put 60,000. Amount column put 60,000. So we have calculated entire liability side, whereas we should calculate all the assets now. So we have calculated total assets. And next they have given is inventory turnover, that is 4 times. What is the formula for inventory turnover? Cost of goods sold divided by average inventory. So inventory turnover we know 4 times, and cost of goods sold we know 2,16,000. With this we can find average inventory. So below that, point number 5. Point number 5, calculation of inventory. Calculation of inventory. So ITR, that is inventory turnover ratio, is equal to cost of goods sold divided by inventory. Cost of goods sold divided by inventory. So inventory is equal to, if inventory goes to the left hand side, it becomes numerator. ITR comes to the right hand side, it becomes denominator. So inventory is equal to cost of goods sold. How much we calculated? 2,16,000. So 2,16,000 divided by, what is the inventory turnover ratio? 4 times. So 2,16,000 divided by 4, that is 54,000. So inventory is 54,000. So with this we have calculated inventory, that is stock. So below that, what they have given, the next thing, average collection period. So they have given average collection period is 20 days. Average collection period is 20 days. What is the value of debtors then? Credit sales into average collection period is the total debtors. So below that, point number 6. Below that, point number 6 is equal to credit sales. Point number 6, calculation of value of debtors. Calculation of value of debtors is equal to credit sales into average collection period. Credit sales into average collection period. So what is credit sales? 2,16,000. Credit sales is 2 lakh is equal to 2,16,000 into, what is the average collection period? 20 days. So 20 divided by 360 is the average collection period. So 2,16,000 into 20 divided by 60. Into 20 divided by 60, which is equal to 12,000. So value of debtors is 12,000. Simple. This is combination of two formulas. This value of debtors. First, how can we, if we have average collection period, what is the formula for average collection period of debtors? 360 divided by debtors turnover ratio. What is the formula for debtor turnover ratio? Debtor turnover ratio formula is credit sales divided by average credit sales divided by average debtors. So average receivables. So the formula is credit sales into average. The formula is credit sales divided by average receivables into 360. Okay, when we reciprocal it, that is when we have average collection period, the 360 becomes denominator and period becomes average collection period becomes numerator. So 2,16,000 into 20 divided by 60 is equal to 12,000. So simply remember this formula. To calculate value of debtors, if they have given average collection period, just multiply it with the credit sales. So average collection period 20 days they have given. 20 by 360 into credit sales 2,16,000 is 12,000. With this, we have calculated value of debtors and inventory. And next, point number 7, which we have already finished in the balance sheet. That is how to calculate long-term debt. Point number 7, they have given long-term debt is 40% to equity. So long-term debt is equal to equity into 40%. Long-term debt is equal to equity into 40%. How much is the equity? 6 lakh into 40% is equal to 6 lakh into 40%, which is equal to 2,40,000. It is equal to 2,40,000. So that is long-term debt. Next, what they have given is current ratio. This current ratio. With this, we can find what is current assets. So in this, we found that by balancing figure, by calculating the balancing figure, we found that current liabilities is 60,000. So when current liability is 60,000, what is the current ratio? 1.8. So 60,000 into 1.8 is the current assets. Simple. So below that, point number 7, that is point number 8. Current ratio is equal to current assets divided by current liabilities. Current ratio is equal to current assets divided by current liabilities. Below that, current assets is equal to current ratio into current liabilities. When current liabilities comes to the left hand side, it becomes numerator. So current ratio into current liabilities. What is current ratio? 1.8 they have given in the question. What is current liabilities, which we found? Balancing figure 60,000. So 1.8 into 60,000. Current assets is equal to 1.8 into 60,000 is equal to 1,08,000. 1,08,000. So we have found what is current assets. Next is point number 9. What is fixed assets? What is fixed assets? Total assets minus current assets is the fixed assets. So point number 9, fixed assets is equal to total assets minus current assets. Total assets minus current assets, which is 9 lakh minus 1,08,000. 9 lakh minus 1,08,000 is equal to 7,92,000. 7,92,000. Fixed assets is equal to 7,92,000. So below that, point number 10. What is cash and bank balance? So whatever is left over in the current asset, except inventories and debtors, others are cash and bank balance. We are assuming it as cash. We can even mention it as other current assets, or you can even mention it as quick assets. Anything is fine, but cash and bank balance is a common term used in the business other than inventories and debtors. So point number 10. Point number 10. Cash and bank balance is equal to current assets minus inventories minus debtors. Current assets minus inventories minus debtors. That is 1,08,000 minus 54,000 minus 12,000. 1,08,000 minus 54,000 minus 12,000, which is equal to 42,000. Equal to 42,000. So with this, we have found what is cash and bank balance, what is fixed assets, and what is current assets, long-term debt, and value of debtors and inventory. Now we should bring it everything to the balance sheet. First, fixed assets. Fixed assets, working note number 9. How much we found with your fixed assets? 7,92,000. 7,92,000. Below that, current assets. Below that, current assets. Write one by one. Inventory. Inventory, how much we found in within bracket working note number 5. Within bracket working note number 5, 54,000. 54,000. Below that debtors. Below that debtors. Within bracket working note number 6. Within bracket working note number 6. Amount column 12,000. Amount column 12,000. Below that debtors cash and bank balance. Cash and bank balance. Working note number 10. Within bracket working note number 10. How much we found? Current assets minus inventory minus debtors. That is balancing here is the cash balance. So 42,000. 42,000. 42,000. So with this we have completed problem number 6. We have found the balance sheet. So moving on to the next question, that is problem number 8. See, problem number 8 is also preparation of balance sheet. Same method, but here they have given other items of liabilities, that is reserves and surplus, all those things. So you can, I don't think so you can solve it on your own, but then what will do? Okay, we'll finish that also. Problem number 8. Problem number 8. First, we'll read the question. The following figures and ratios are related to Bharati Limited. The following figures and ratios are related to Bharati Limited. Sales for the year, all sales are on credit, 30 lakhs. Gross profit ratio 25%, which means 30 lakhs into 25%, which is 7,50,000. So from that 7,50,000, if we reduce from 30 lakhs, we'll get 22,50,000 is the cost of goods sold. And fixed asset turnover ratio is 1.5. What is the formula for fixed asset turnover ratio? Cost of, they are given basis on cost of goods sold. So cost of goods sold divided by fixed asset. So how much is the cost of goods sold? 22,50,000. So 22,50,000 divided by fixed assets is equal to fixed asset turnover ratio. Here, if it is come in the denominator side divided by 1.5, we'll get 15 lakhs is the fixed assets. So next they have given stock turnover ratio. What is the stock turnover ratio? Cost of goods sold divided by average stock. So it is 6 times. So cost of goods sold is 22,50,000 divided by 6 is the average stock. That is inventory. Next, liquid ratio. Liquid ratio is nothing but liquid assets divided by liquid liabilities. 1:1. Current ratio is current assets divided by current liabilities. Debtor collection period is 2 months. Using this, we can find what is debtors. And reserves and surplus to share capital is 0.6:1. So here the share capital, they haven't mentioned share capital, whereas they have mentioned total assets. So we can use the total of assets as total of liabilities, and we can find the what is equity share capital and reserves and surplus. Next is capital gearing ratio and fixed asset to net worth. They have also given fixed assets to net worth, which means on net worth, fixed assets is 1.2%. 1.2:1. That is fixed assets 15 lakhs divided by 1.2. We'll get 15 lakhs divided by 1.2. We'll get 12,50,000, which is the net worth. So using all these formulas, you are required to prepare the balance sheet of B Limited on the basis of above details. Okay. First put the heading. Problem number 8. Problem number 8. Statement number 1. Balance sheet of B Limited. Balance sheet of B Limited. Now below that, divide the page into 2 parts. Liabilities, left hand side liabilities and right hand side assets. Left hand side liabilities amount, right hand side assets amount. Then we have to find all the details. They have not mentioned anything directly except sales. Except sales of rupees 30 lakhs, they have not given any values. So you have to do all the working notes. See, working notes are form part of answer. So like if you are not writing working notes clearly, definitely they'll reduce the marks. So below that, leave 10 lines gap. Below that, below the liabilities, leave 10 lines gap. Put the heading working notes. Put the heading working notes. Below that, point number 1, calculation of cost of goods sold. Calculation of cost of goods sold. They have given sales and gross profit ratio. If we reduce that, we'll get cost of goods sold. So below that, gross profit is equal to 30 lakhs into 25%. 30 lakhs into 25% is equal to 7,50,000. Is equal to 7,50,000. So we have found gross profit is 7,50,000. So below that, cost of goods sold is equal to sales minus gross profit. Sales minus gross profit, which is equal to 30 lakhs minus 7,50,000. 30 lakhs minus 7,50,000, which is equal to 22,50,000. Which is equal to 22,50,000. So cost of goods sold is 22,50,000. Below that, point number 2. Point number 2, calculation of fixed asset. Calculation of fixed asset. Usually, what is the formula for fixed asset? Total sales divided by fixed assets. Whereas here they have clearly mentioned basis on cost of goods sold. So fixed asset turnover ratio. Below that, fixed asset turnover is equal to cost of goods sold divided by fixed asset. Cost of goods sold divided by fixed asset. If fixed asset goes to the left hand side, it becomes numerator. Fixed asset turnover comes to the right hand side, it becomes denominator. So fixed asset is equal to, below that, fixed asset is equal to 22,50,000 divided by 1.5. 22,50,000 divided by 1.5, which is equal to 15 lakhs. 15 lakhs. So fixed asset is equal to 15 lakhs. So now come to the balance sheet asset side. Fixed assets 15 lakhs. Fixed assets within bracket working on number 2, 15 lakhs. 15 lakhs. So below that, calculation of fixed asset, point number 2. Now take down point number 3. Point number 3, calculation of inventory. Calculation of inventory. Below that, what is inventory turnover ratio formula? Cost of goods sold divided by average inventory. Okay. ITR is equal to, that is inventory turnover ratio is equal to cost of goods sold divided by inventory. Cost of goods sold divided by inventory. So if inventory comes to the left hand side, it becomes now a numerator. So inventory is equal to, what is cost of goods sold? 22,50,000 divided by 6. Divided by 6. 22,50,000 divided by 6. So 3,75,000. That is inventory. So inventory is 3,75,000. So take that inventory to the balance sheet. Below that fixed asset, put current assets. Current assets. Below that, inventory. Below current assets, inventory. Within bracket working on number 3. Inventory within bracket working on number 3. Amount column 3,75,000. Amount column 3,75,000. Now below that, point number 3, take down point number 4. Point number 4, calculation of current liabilities. Calculation of current liabilities. See, usually current assets and quick assets vary only with 2 items, that is inventory and prepaid expenses. We are assuming that in this particular sum there is no prepaid expenses. Okay, we are assuming that, you just take down it in the bracket, assuming in the left hand side you just write it, assuming there is no prepaid expenses and bank OD. In current liabilities also there is no bank OD. So assuming there is no prepaid expenses and bank OD. So what is the difference between current assets and quick assets then? Only inventory. And current liabilities and quick liabilities, nothing, because there is no bank OD. We have assumed there is no bank OD. So point number 4, calculation of current liabilities. Inventory ratio is equal to current ratio minus quick assets ratio. That's all, simple. Current ratio, if you reduce quick ratio from the current ratio, you will get inventory ratio. That's all. Inventory ratio is equal to current ratio minus quick ratio. Here current ratio divided by current ratio is equal to current assets minus current liabilities, whereas quick ratio is equal to quick assets minus current liabilities. So both the denominators are same. So current assets minus quick assets, what is that? 1.5 minus 1 is equal to, what is current ratio? 1.5, and quick ratio 1. So 1.5 minus 1 is equal to 0.5. So inventory ratio is equal to 0.5. So 0.5 is equal to, what is the inventory we calculated? 3,75,000. So 0.5 is equal to 3,75,000. 0.5 is equal to 3,75,000. So 1 minus current liabilities is equal to 1 minus current liabilities is equal to 3,75,000 divided by 0.5. 3,75,000 divided by 0.5. So we'll get 7 lakhs. That is the current liabilities. Simple man, current liabilities is equal to 3,75,000. What is the formula for inventory ratio? For inventory ratio, like current ratio is current assets divided by current liabilities. Quick ratio is quick assets divided by current liabilities. Then inventory ratio, which is similar to this formula, is inventory divided by current liabilities. Here we know inventory is 3,75,000. Current liabilities we don't know. So current liabilities is equal to 3,75,000 divided by 0.5. This 0.5 is nothing but inventory divided by current liabilities. We are taking this 0.5 down and we are taking this 1 by current liabilities. So current liabilities is equal to 3,75,000 divided by 0.5. 3,75,000 divided by 0.5 is equal to 7 lakhs. 7,50,000 is equal to 7,50,000. So we have found that current liabilities is equal to 7,50,000. With this, we can easily find what is current assets and quick assets. When current liabilities is 7,50,000, what is the current ratio? 1.5 is to 1. So 7,50,000 into 1.5 is the current assets. So below that, point number 5. Below that, point number 5, calculation of current assets and quick assets. Calculation of current assets and quick assets. Below that, current assets is equal to 7,50,000 into 1.5. 7,50,000 into 1.5, which is equal to 11,25,000. Which is equal to 11,25,000. Below that, quick assets is equal to 7,50,000 into 1. 7,50,000 into 1, which is equal to 7,50,000. Is equal to 7,50,000. It is equal to 7 lakh. So we have found current assets, quick assets. If you reduce from current assets, that is 11,25,000. If you reduce the inventory, that is 3,75,000, we get the quick assets, that is 7,50,000. So calculations are right. So with this, we have found is we have found what is current assets, quick assets, and current liabilities. So just come to the balance sheet. Come to the balance sheet. Leave 4 lines gap. Leave 4 lines gap. That is from below, from the bottom. That is for leave the gap for liabilities. That is share capital, reserves, and long-term debt from the top, and right after 5 lines current liabilities. Current liabilities, that is 7,50,000. Amount column 7,50,000. That is what we have found. Current liabilities. So we have found what is current assets and what is quick assets. With this, we can easily find what is cash balance after finding debtors. So below that, point number 6. Below that, point number 6, they have given debtors collection period is 2 months. See, debtors collection period 2 months. What is the formula for debtors collection period? 360 divided by the debtors turnover ratio. What is debtors turnover ratio? Credit sales divided by average debtors. Okay, credit sales divided by average debtors. So 360 divided by credit sales divided by average debtors, which is equal to average debtors is equal to credit sales divided by credit sales into average collection period. Credit sales into average collection period. Simple. Just remember this formula. Like write it down separately. Debtors collection period is equal to 2 months, which means debtors is equal to credit sales into average collection period. In between this both, just take it down. Debtors is equal to credit sales into average collection period. This is separate formula which we didn't study in the theory. Debtors is equal to credit sales into average collection period. Here, what is the credit sales? 30 lakhs. What is average collection period? 2 months. So 30 lakhs into 2 by 12 is equal to 5 lakh rupees. So remaining is cash and bank balance. See, out of quick assets, if we deduct out of current assets, if we deduct debtors and inventory, we'll get what is cash and bank balance. Below that, point number 7. Cash and bank balance is equal to current assets. What is current assets that we found? 11,25,000. So current assets minus inventory minus debtors, which is equal to current assets minus inventory minus debtors. Current assets minus inventory minus debtors, which is equal to 11,25,000 minus 3,75,000 minus 5 lakhs. 11,25,000 minus 3,75,000 minus 5 lakhs, which is equal to 2,50,000. With this, we have completed asset side entirely. Now come to the balance sheet. Below that, inventory 3,75,000 record. Debtors, working note number 6. Amount column 5 lakhs. How did we find debtors? Credit sales into average collection period. Debtors is equal to, just write down this formula. Remember this formula. Debtors is equal to credit sales into average collection period. That is amount column 5 lakhs. Below the debtors, cash and bank. Within bracket, working note number 7. Amount column 2,50,000. 2,50,000. Now total the asset side. 15 lakhs plus 3,75,000 plus 5 lakhs plus 2,50,000. So total assets is 26,25,000. 26,25,000. Now total the asset side. Now total the liability side. Bring it to the liability side. 26,25,000. 26,25,000. Total of liability is 26,25,000. Here we don't know any values. We only know current liabilities value. That is current liabilities is 7,50,000, and we don't know any values regarding the total funds. So we should calculate it using the given formulas, given ratios. Now below that, working note number 7, put point number 8. Calculation of net worth, that is equity. Calculation of net worth or equity. Net worth and equity are same. So equity, if we add the preference share capital, it will be end up with net worth. So calculation of net worth or equity. Below that, what formula they are given? Fixed assets to net worth is 1.2:1. So fixed assets to net worth formula is fixed assets divided by net worth. What is fixed assets? 15 lakhs. So 15 lakhs divided by 1.2, that is 12,50,000. So fixed assets to net worth is equal to fixed assets divided by net worth. Which is equal to 15 lakhs divided by 1.2. 15 lakhs divided by 1.2 is equal to 12,50,000. 12,50,000. In respect of the 12,50,000, write net worth. In respect of the 12,50,000, therefore net worth. We have found net worth is 12,50,000, and reserves and surplus to share capital is 0.6:1. See, net worth is 12,50,000. So reserves and surplus to share capital. So net worth consists of capital, reserves and surplus, profit and loss account. So when reserves and surplus and share capital are shown as 0.6:1, that is 0.6 plus 1 is the total net worth. Reserves and surplus plus share capital is equal to total net worth. So below that, calculation of reserves and surplus. That is 12,50,000. 12,50,000. One second. 12,50,000 divided by 1.6 into. Okay, here see. Calculation of resource. Working out below that, working out number 9. Below net worth, working out number 9, calculation of resource. Here, see, reserves is 0.6 is to 1. That is, reserves to share capital is 0.6 is to 1. So, total net worth is nothing but 0.6 plus 1. That is total net worth. Reserves and surplus plus share capital is the net worth. So, 1.6 is, we found 12,50,000. Then what is 0.6 and what is 1? That we should find. So, point number 9, calculation of reserves. Calculation of reserves, which is equal to 12,50,000, that is net worth, 12,50,000 divided by 1.6 into 0.6. 12,50,000 divided by 1.6 into 0.6. So which is equal to 4,68,750. 4,68,750. Below that, share capital is equal to 12,50,000 divided by 1.6 into 1. So 12,50,000 divided by 1.6 into 1 is equal to 7,81,250. 7,81,250. So with this, we have calculated what is share capital, what is reserves. See, simple man, reserves and share capital put together is the net worth. Okay. So we have found that reserves to share capital is 0.6 is to 1. Then what is net worth? 0.6 plus 1 is the net worth. So net worth is 1.6. So using that, we found what is reserves and what is share capital. So with this, we can write two things in the liabilities. That is, liabilities, below that record share capital. Share capital, working out number 9, 7,81,250. 7,81,250. Below that, reserves, working out number 9, within bracket working out number 9. Reserves within bracket working out number 9, 4,68,750. 4,68,750. The reserves working out number 9, 4,68,750. So with this, we have found what is share capital, what is reserves. Now one last item left over, what they are given is capital gearing ratio. See, do you remember what is capital gearing ratio when we studied theory? Simple. Whatever we are paying fixed charge capital, those are in the numerator, that is the debt, divided by equity shareholders, that is which is not paid as fixed charge on capital. Suppose, see, preference share capital, debenture holders, all these paid on fixed share capital, that is fixed charge on capital, that is 12% debentures, 13% preference shares. So the final one, that is capital gearing ratio, that is equal to debt divided by equity. Sorry, I had a call, so I had left debt divided by equity shareholders. Yes. See, capital gearing ratio is nothing but all the fixed charge on capital funds will come on the top and the remaining equity will come on the denominator. So here in this problem, only debt is there for which a fixed charge is paid, whereas equity shareholders are paid at the remaining profits. So debt divided by equity shareholders, capital gearing ratio is equal to debt divided by equity shareholders. So how much is the capital gearing ratio? They have given 0.5. So 0.5 is equal to debt divided by what is the equity share capital? 12,50,000. So 0.5 is equal to debt divided by 12,50,000. So debt is equal to 6,25,000. So take down, capital gearing ratio is equal to debt divided by equity shareholders funds. Debt divided by equity shareholders funds. So 0.5 is equal to debt divided by 12,50,000. Debt divided by 12,50,000. Debt is equal to 6,25,000. So with this, we have calculated what is debt. So now long-term debt balancing figure 6,25,000. We can even calculate it as balancing figure, but we actually have capital gearing ratio so that we can calculate it with formula itself. If you don't want to waste time, like instead of calculating the capital gearing ratio, if you go with the balancing figure also, it will tally. So long-term debt, below that reserves, long-term debt 6,25,000. 6,25,000. With this, problem number 8 is done. This problem number 8 done. Problem number 8 is done. So next we'll move on to problem number 7. Problem number 7 and problem number 10 is left over. So what is problem number 7? They have given problem number 7. JKL Limited, the following balance sheet as on March 31st, 2016 and March 31st, 2015. For both years, they have given balance sheet. Shareholders fund, loan funds, application of funds. They have used the funds for fixed assets, cash and bank, data, stock, other current assets, less current liabilities. So the income statement of JKL Limited for the year ended is as follows. So they are given income statement also. That is sales less cost of goods sold, will get gross profit, less selling and general and administrative expenses, will get earnings before interest and tax. EBIT, that is EBIT. EBIT less interest expenses will get PBT, less tax will get profit after tax. With this, you want to calculate for the year 2015-16 inventory turnover ratio, financial leverage, return on investment, return on equity, and average collection period. So one by one we'll go. That is inventory turnover ratio. Now put the heading. Problem number 7. Problem number 7. Calculation of required ratios. Calculation of required ratios. Point number A. Point number A, inventory turnover ratio, ITR. Inventory turnover ratio is equal to, what is the formula for inventory turnover ratio? Cost of goods sold divided by average inventory. So is equal to cost of goods sold divided by average inventory. For the year 2016 to 17, what is the cost of goods sold? 20,860. That is equal to 20,860 divided by, calculate the, leave two lines gap. Leave two lines gap. Below that, note number 1. Note number 1. Average inventory is equal to opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by 2, which is equal to, what is the opening stock they have given? Opening stock is 2407 plus 2867 divided by 2, which is equal to 2637. 2637. Now come to the formula. 20,860 divided by 2,637. 2,637, which is equal to 7.91 times. 7.91 times is equal to 7.91 times. So next they have asked us to calculate financial leverage. Degree of financial leverage. The formula for financial leverage, that is degree of financial leverage, is EBIT divided by EBT. Take it down. Take it in the material, or take the note in the note itself, that is in your study note itself. That is point number B, degree of financial leverage. Degree of financial leverage is equal to EBIT divided by EBT. EBIT divided by EBT. That is the formula of financial leverage. That is how much, see, EBT is nothing but what is your profit after making interest payment, and EBIT is what is your profit before making interest payment. Because of this interest, how much is your leverage you are doing in your profit? That is called degree of leverage. So EBIT divided by EBT. So what is the EBIT given in the formula? Given in the question, EBIT is 170, EBT is 57. So EBIT divided by EBT is equal to 170 divided by 57. 170 divided by 57 is equal to 2.98 is to 1. 2.98 is to 1. So next they have asked us to calculate point number C, return on investment. What is return on investment? See, return on investment is nothing but what is your EBIT into 1 minus tax rate. That is EBIT into 1 minus tax rate divided by average capital employed. That is the return on investment. Simple. Return on investment is nothing but how much is your profit divided by how much is your investment. Here for profit we are taking EBIT into 1 minus tax rate, whereas for investment we are taking average capital employed. We should not take the capital employed on the last day, because we should always assume capital employed as average capital employed. So point number C. Point number C. Return on investment is equal to EBIT into 1 minus tax rate divided by average capital employed. EBIT is into 1 minus tax rate is nothing but what is the profit after tax including interest, that is EBIT into 1 minus tax rate. So EBIT below that 170 within bracket 1 minus what is the tax rate that we should find. Leave 4 lines gap. Leave 4 lines gap. Interest rate they have not given. We should calculate the interest. Leave 4 lines gap. Note number 1. What is the tax they have paid? 23. What is the profit before tax? 57. So note number 1. Tax rate is equal to tax divided by PBT. That is 23 divided by 57 into 100. 22 divided by 57. 23 divided by 57 into 100. So tax rate is 40.35%. 40.35%. Note number 1. Tax percentage is equal to tax divided by PBT is equal to 23 divided by 57 into 100. 23 divided by 57 into 100, which is equal to 40.35%. That is note number 1. Next, note number 2. Average capital employed is equal to what is the capital employed in the previous year? Capital employed in the previous year is 4555 and current year is 5947. Add both. 5947 plus 4555 divided by 2. That is average capital employed. So average capital employed is equal to 5947 plus 4555 divided by 2 is equal to 5251. How come it is 5947 plus 4555 divided by 2 is equal to 5251 is equal to 5251. Now come to the formula. EBIT is 170 into 1 minus what is the tax rate? 40.35. So 1 minus 40.35%, close the bracket, divided by what is average capital employed? 5251 divided by 5251 into 100. So what is 1 minus 0.4035? It is 59.65, 0.5965 into 170. You will get 101.405 divided by 5251 into 100. That is 1.93 is equal to, and the answer for return on investment is equal to 1.93%. 1.93%. With this, we have completed return on investment. Next, return on equity. Next, what is return on equity? For return on equity, we should always take profit after tax, because equity, for equity shareholders, the profit available is only this profit after tax. They are not going to be calculated. They are not going to get any profit from this EBIT. That is, this EBIT belongs to both debentures and equity shareholders, whereas this profit after tax solely belongs to equity shareholders. So for return on equity, you should always take profit after tax. So return on equity is equal to profit after tax divided by equity. Profit after tax divided by average equity. So what is the profit after tax? 34. So below that, point number D, return on equity is equal to profit after tax divided by average equity. Profit after tax divided by average equity into 100. So what is the profit after tax is equal to 34. Profit after tax is 34 divided by average equity. Below that, leave 2 lines gap. Average equity is equal to 2377 plus 1472 divided by 2 is equal to 1924.5. 1924.5, which is, now come to the formula, 34 divided by 1924.5 into 100 into 100. 1924.5 into 100, which is equal to 1.77%. 1.77%. And the last requirement is average collection period. For calculating this average collection period, we need debtors turnover ratio. So first we should calculate debtors turnover ratio, then only we can calculate average collection period. So debtors turnover ratio formula is credit sales divided by average receivables. Here credit sales, we are assuming all the sales as credit sales. So point number E, credit debtors turnover DTR is equal to, debtors turnover ratio is equal to credit sales divided by average receivable. Credit sales divided by average receivable, which is equal to, what is the credit sales? We are assuming all the sales are credit sales. So 22,165 divided by, what is average receivable? We should calculate the average receivable by finding the average of both the debtors. That is, below that leave 2 lines gap, below that leave 3 lines gap. Note number 1, average receivables is equal to opening debtors plus closing debtors divided by 2. Opening debtors plus closing debtors divided by 2, which is equal to, what is the opening debtors? 1168 plus 1495 divided by 2, which is equal to 1331.5. 1331.5. So this is average receivable, which means average of both the debtors. So credit sales divided by average receivable, you will get debtor turnover ratio. So coming to the formula, 22,165 divided by 1331.5 is equal to 16.65 times. So we have found debtor turnover ratio is 16.65 times. See, average, they have asked us average collection receivable. Okay, average collection period. We have studied in the theory part that average collection period, collection means it is from debtors. Average payment means it is from creditors. So average collection period is nothing but 360 divided by debtors turnover ratio. So for that we need debtors turnover ratio. First we calculated debtors turnover ratio. That is credit sales divided by average receivable, which is 16.65 times. So now average, below that note 1, arrow mark, average collection period is equal to 365 days divided by, what is debtors turnover ratio? 16.65. So 365 divided by 16.65, which is equal to approximately 22 days. 365 divided by 16.65, that is approximately 22 days, which is equal to 22 days. With this we have completed problem number 7. And next is problem number 10. See, problem number 10 and problem number 8 are totally similar, where you can, using this formulas, you can find the answers for this problem number 10 too. What are the different formulas in this? Current assets, net working capital is current assets minus current liabilities. Inventory you can find cost of goods sold, sales value, fixed asset turnover ratio, debtors, net cash bank, shareholders net worth, calculation of share capital, calculation of reserves, creditor turnover ratio, calculation of fixed assets. All are repeated formulas. So point number 10, see problem number 10. Okay, we'll finish it. Problem number 10. With the help of the following ratios regarding Indumati, draw the balance sheet of the company for the year 2015. It is repeated sum, you can easily do it. They have given current ratio 2.5, liquid ratio 1.5, net working capital 3 lakhs. That is, this 2.5 is 3 lakhs. Then what is 1 and what is what is 1? If we calculate what is 1, that is current liabilities. So next is stock turnover ratio, cost of sales divided by closing stock. So 6 times. Gross profit ratio 20%, fixed asset turnover ratio 2 times, debt collection period 2 months, fixed asset to shareholders net 0.8, reserves and surplus to capital 0.5. So with this we should calculate, draw the balance sheet. So put the heading, point number 10, problem number 10, balance sheet of dot dot as on dot dot, balance sheet of dot dot as on dot dot. Below that, divide the page into 2 parts. Left hand side liabilities amount and right hand side liability assets amount. Left hand side liabilities amount and right hand side assets amount. Left hand side liabilities amount and right hand side assets amount. Okay, we'll go one by one. Liabilities. See, first in this formula what they have given is current ratio. So using this current net working capital, we can easily find what is current assets and current liability. So leave 10 lines gap. Leave 10 lines gap. Below that put working notes. Below that put working notes. Working notes. Note number 1. Calculation of current assets and current liabilities. Calculation of current assets and current liabilities. So below that, below that take the formula, net working capital is equal to current assets minus current liabilities. That is, net working capital is equal to current assets minus current liabilities. What is the current assets minus current liabilities formula? What is the ratio they have given for current ratio? 2.5:1. So current assets is 2.5, current liabilities is 1. So 2.5 minus 1 is net working capital. So 2.5 minus 1, which is equal to 1.5. So 2.5 minus 1, which is equal to 1.5. This 1.5 is nothing but net working capital. So net working capital amount, how much they have given? 3 lakhs. So 1.5, below that 1.5 is equal to 3 lakhs. If suppose this 1.5 is equal to 3 lakhs, what is the current liabilities we should find? So below that current liabilities is equal to 3 lakhs divided by 1.5 into 1. 3 lakhs divided by 1.5 into 1, which is equal to 2 lakhs. So current liabilities is 2 lakhs. Below that current assets is equal to 3 lakhs divided by 1.5 into 2.5. 3 lakhs divided by 1.5 into 2.5 is equal to 5 lakhs. Current liabilities is 2 lakhs and current assets is 5 lakhs. So we found current assets and current liabilities. Next, what they are given is stock inventory ratio, that is stock turnover ratio, which means inventory turnover ratio. The formula they have given is cost of sales divided by closing stock. So we know what is stock turnover ratio, and we know we are finding this inventory value using the other method, that is in the previous problem as we discussed, current ratio minus liquid ratio, we will get inventory ratio, because inventory is the only thing which is difference between current and liquid, whereas we are assuming that bank OD, there is no bank OD and prepaid expenses and cash credit. So with this we can calculate the inventory. So below that, point number 2, calculation of inventory. Inventory ratio is nothing but current ratio minus liquid ratio. The difference between current ratio and the liquid ratio is only inventory. We are assuming it like that. So inventory is equal to current ratio minus liquid ratio, which is equal to, what is current ratio? 2.5. Liquid ratio is 1.5. So 2.5 is to 1.5, which is equal to 1:1. So inventory is 1:1, inventory ratio. So if current liabilities is 2 lakh, inventory is also 2 lakh, because if current liabilities is 1 and inventory is also 1, whatever the current liabilities is there, inventory is also the same value. So below that current liabilities 2 lakh, so inventory is equal to 2 lakh. So with the reverse working, we found that what is inventory, like inventory ratio is equal to current ratio minus liquid ratio. So we know that current liabilities is 2 lakh and inventory ratio is 1:1. So when inventory ratio is 1:1, that is inventory divided by current liabilities is equal to 1:1. And if 2 lakhs is 1 and the current ratio, that is inventory is also 2 lakhs. So below that, point number 3. Now we know inventory. Using this, we can find what is cost of sales. So below that, point number 3, calculation of cost of goods sold. Calculation of cost of goods sold. Below that, stock turnover ratio is equal to cost of goods sold divided by closing stock. Cost of goods sold divided by closing stock. So cost of sales is equal to 6 into 2 lakhs. Cost of sales. See, simple. Stock turnover ratio is cost of sales divided by closing stock. Here we know what is stock turnover ratio and we know what is closing stock, that is inventory. So cost of sales is equal to closing stock into stock turnover ratio. Closing stock is 2 lakhs and in stock turnover ratio is 6. 6 into 2 lakhs, that is 12 lakhs. So cost of sales is equal to 12 lakhs. Cost of sales is equal to 6 into 2 lakhs is equal to 12 lakhs. And point number 4, calculation of sales value. Calculation of sales value. See, they have given gross profit is 20% and cost of sales is 12 lakhs. So 20% is the gross profit. Then how much is the cost? 80% is equal to sales value 100. So cost plus profit is equal to sales. Here they have expressed gross profit as a percentage of sales. So sales is 100, gross profit is 80. Then cost is, sales is 100, gross profit is 20. So cost is 80. So cost of sales into 20 divided by 80. So profit is equal to cost of sales into 20 divided by 80. So profit is equal to 1,20,000 into, that is not 1,20,000, 12 lakhs into 20 divided by 80. 12 lakhs, that is cost of goods sold, into 20 divided by 80. So that is the gross profit is equal to 3 lakhs. So now what is the sales? Total sales is equal to cost plus profit, that is 3 lakhs plus 12 lakhs. So below that, total sales is equal to cost plus profit. How much is the cost? 12 lakhs. And how much is the profit? 3 lakhs. Both put together 15 lakhs is equal to 15 lakhs. We found what is sales. Now fixed asset turnover ratio 2 times. We can easily find what is fixed asset using this because we know what is cost of sales, that is 12 lakhs. So below that, point number 5, fixed asset turnover ratio is equal to cost of sales divided by fixed assets. Cost of sales divided by fixed assets. So below that, fixed assets is equal to, see here we know what is fixed asset turnover ratio and what is cost of sales. So we can easily find what is fixed assets. If it goes to numerator, this comes to left, right hand side, that is denominator. So fixed assets is equal to what is cost of sales? 12 lakhs divided by what is fixed asset turnover ratio 2 times is equal to 6 lakh. So fixed asset is equal to 12 lakhs divided by 2 is equal to 6 lakhs. And next is point number 6. See, fixed asset turnover ratio, using that we found what is fixed asset. And debt collection period. Using this debt collection period, we can easily find what is debtors. What is the debt collection period formula? Calculation of debtors is equal to credit sales into average collection period. Here we are assuming entire sales as credit sales. Then what will happen? Entire sales into what is the debt collection period? 2 by 12, that is debtors. So below that, point number 6, calculation of debtors. Calculation of debtors. So debtors is equal to credit sales into average collection period. Credit sales into average collection period, which is equal to what is credit sales? We are assuming all the sales as credit sales. So total sales is 15 lakhs as we found. So 15 lakhs into what is the debt collection period? 2 months divided by 12 months. So into 2 by 12. 15 into 2 by 12, which is equal to 2,50,000. 2,50,000. So we found what is debtors and what is stock. So we can easily find what is the cash and bank. As we found what is current assets. Current assets we found that it is 5 lakhs. Okay. Current assets we found it is 5 lakhs. From that, if you reduce inventory and if you reduce debtors, you will get what is cash and bank. So below that, point number 7. Calculation of cash and bank. Cash at bank is equal to, below that, cash at bank is equal to current assets minus inventory minus debtors. Current assets minus inventory minus debtors. So what is current assets? 5 lakhs. And what is inventory? 2 lakhs. And debtors is 2,50,000. If you reduce all, you will get is equal to 50,000. Cash at bank is equal to 50,000. So below that, point number 8. Calculation of shareholders net worth. Calculation of shareholders net worth. See, they have given after debt collection period fixed assets to shareholders net worth. We found that fixed assets is 6 lakh. So using that, we can easily find what is shareholders net worth. Fixed assets to shareholders net worth is 0.5. What is the formula then? Fixed assets divided by shareholders net worth is equal to 0.8. So shareholders fixed assets divided by 0.8 is equal to shareholders net worth. So point number 8, calculation of shareholders net worth. Shareholders net worth. Below that, write the formula. Fixed assets to net worth is equal to fixed assets to net worth is equal to fixed assets divided by net worth. Fixed assets divided by net worth. So if net worth goes to left hand side, it becomes numerator, and fixed assets to net worth ratio will become denominator. So net worth is equal to, what is fixed assets? 6 lakh as we find. 6 lakh divided by 0.8 is equal to 7,50,000. So net worth is 7,50,000. So total net worth is 7,50,000. What is net worth? Both put together, reserves and surplus and capital is the net worth. So here we have found that reserves and surplus to capital is 0.5. So 0.5 plus 1 is equal to 1.5. So this 1.5 is net worth. Last time we did the same working. Net worth is nothing but summation of reserves and surplus and capital. Here they have given reserves and surplus to capital is 0.5. So 0.5 plus 1, 1.5 is the net worth. So below that, point number 9. Below that, point number 9. Calculation of share capital. Calculation of share capital is equal to 7,50,000. How much is the share capital here? 1. But net worth is 1.5. So 7,50,000, that is net worth, divided by 1.5 into 1, which is equal to 5 lakhs. 7,50,000 divided by 1.5 is to 1 is equal to 5 lakhs. Below that, calculation of reserves is equal to 7,50,000 divided by 1.5 into 0.5, because reserves is 0.5 of net worth. Net worth is 1.5. Reserves is 0.5 and capital is 1. So calculation of resource is equal to 7,50,000 divided by 1.5 into 1.5 is equal to 2,50,000. 2,50,000. So with this, actually this is not, this is some other page. With this, sum has got over. So we have calculated what is share capital, that is 5 lakhs, reserves, that is 2,50,000. Remaining is the balancing figure, that is long-term funds. So come to the balance sheet. We found below liabilities, put share capital, amount column 5 lakhs. Amount column 5 lakhs. Below that, reserves 2,50,000. 2,50,000. Below that, long-term debt, within bracket balancing figure. Below that, current liabilities. How much did we find current liabilities? 2 lakhs. Current liabilities, amount column 2 lakhs. Come to the asset side. Fixed assets, working note number 5, within bracket working note number 5, we found 6 lakhs. Just taking from the working notes, you are writing in the balance sheet, that's all. Fixed assets, within bracket working note number 5, 6 lakh. Below that, current assets. Under current assets, inventory 2 lakhs, amount column 2 lakhs. Debtors, working note number 6, 2,50,000. Below that, cash and bank 50,000. Now total the asset side. Total it 11 lakhs. 11 lakhs. Now bring it to the liability side and total it 11 lakhs. 11 lakhs. Now 5 lakh plus 2,50,000 plus 2 lakh, which is 9,50,000. The remaining balancing figure is long-term debt. In previous sum, they have given capital gearing ratio, where you can find that long-term debt even using formula. Whereas here they didn't give any long-term capital gearing ratio, so you should go with long-term debt as balancing figure. That is rupees 1,50,000. Rupees 1,50,000. Super. With this, we have completed this ratio analysis. And ratio analysis is also over. So now we'll move on to next chapter, that is leverage analysis. Leverage analysis is also a very important chapter. Easy chapter, but it is also very important from examination point of view. So with this, we have completed ratio analysis, and still you will have some more problems in ratio analysis, which once after preparing the questions, I will release the questions soon in the video itself. I'll just give the questions. If you can solve, you can solve, or I'll give the PDF for answers also, because actually this is enough. Actually whatever is there in material, that is more than enough. But if you solve those questions also, it will be effective. So in the end, that is, after completing all the chapters, we'll work on all these small things, so that we will get again, will it will be like a revision. Once after completing entire FM, again if we are doing one sum from each chapter, it will be like recalling what is there in that chapter, so it will work. So okay, with this we have completed ratio analysis. We'll see with the leverage analysis in the next video. Thank you guys.